Hi everyone, welcome to the channel. I can almost guarantee that the following thought has crossed your mind at least once. The market is high at the moment, so we better wait off until it drops a bit and then buy then. Probably closely followed by the statement that says something like, the market's low at the moment, I'm not sure if it's a great time to buy, I better wait until I see an upturn before I buy. Two totally different scenarios, but the same outcome, i.e. you put off buying and sit on the sidelines. If this sounds familiar, then you're not alone. I've suffered from this procrastination loads of times. So in this video, we see the effect of trying to time the market and what the best strategy really is. It may surprise you. I'm Anthony, and as always, we're talking money. Talk to one of those very well-paid professional fund managers and they'll probably tell you that the reason why they earn such good salaries is that they're highly skilled at buying at exactly the right time, and such skills are being finely tuned over many years' experience. The actual truth why they earn such great salary is that they earn commission off people who use them. According to some research, only about 2% of fund managers beat the index by more than their commissions. Doesn't sound like they're that good after all. So what would happen if you were the worst investor in the world and only bought at the peaks of the market? If, for example, you only invested in, say, the peak of the 1929 market just before the Great Crash, you'd have to wait 30 odd years until the index was back to where it was. Or more recently, if you'd invested at the peak of the dot-com bubble or just before the financial crash in 2008, it would be a best part of 10 years before you were back in profit. Sounds pretty bad for Mr. and Mrs. Unlucky, but is it really? I strongly urge you to go and have a look at the rather interesting article on the website called Personal Finance Club. I've got nothing to do with Personal Finance Club, by the way. It's just quite an interesting article that takes three fictitious investors who managed to save £200, actually it's $200 because they're an American site, but it's £200 a month from their salaries for the purpose of investing in the stock market. One invests only at the major peaks, most notably at the peak just before Black Tuesday, the Kuwait War, the dot-com crash, the financial crash, and lastly the COVID crash back in March last year. Basically the worst possible times to invest over the last 41 years. The next character was the absolute opposite and only invested in the troughs of the market following the low points of all the aforementioned crashes. She sounds like the luckiest investor in the world. And finally, the third investor just invested her £200 every month regardless of what the market was doing. You would imagine that the worst performer was the one that invested at the peaks of all the market, and you'd be absolutely right. This investor must have lost money, surely. But in actual fact, their £100,000, which is what they invested over that period of 41 years, turned into a staggering £773,000 after dividends throughout that time had been reinvested. The luckiest investor, who timed the market perfectly, ended up with £1,123,000 after 41 years investing, and by all standards did pretty well. But what's absolutely staggering is that the investor who just plonked their £200 per month in the market every month for 41 years ended up with the biggest pot of £1,620,000, beating the luckiest investor by a massive $500,000. Wow. The reasons for this is well established, but actually not that well known, is the fact that most money is lost not from a falling market, but from cash not invested and cash that's basically sitting on the sideline. The reason for this is that most stock market returns come from not capital gain, but from the compounding effect of reinvesting dividends earned from those stocks. The longer you have cash invested in the market, the longer that compounding has got to take effect. Now, it's often said that investing in stocks and shares are risky, and to a certain degree it is. People often cite the situation I started this video off with, and that is that it took 30 odd years to get back to the 1929 level. You could lose all your money, etc., etc. In reality, no one invests all their cash into the stock market on one day and then just leaves it forever and ever, never to invest another penny. In reality, most people invest many times over a period of time. Who on earth invests all their life savings at the peak of the dot-com bubble and has never bought anything since? Even if they had, they'd probably still be up if you take into account those dividends that have been reinvested. The only exception to this, and it brings this video full circle, is that when you retire and you're forced to buy an annuity. And guess who sells and makes money from selling you these products? Yep, you've got it, it's those professional fund managers. Now, before I give fund managers too hard a time, if you jump back onto that personal finance club, I'll put the link in the description below for you, have a play on their game, timing the market, and see how difficult it actually is to time the market. I'll give it a go right now on the computer and see how we get on. Okay, so it only takes about 15 seconds from start to finish, so it's quite a quick game. And you basically try and buy when you think the market is dipping or low, and you try and sell when you think that the market is high. And you just keep pressing buy and sell throughout the period of the game. So just press go and you'll see the graph going up and down. So I'm going to buy, sell, buy, whatever throughout the game, and end up with the result after the 15 seconds or 20 seconds has elapsed. And this is how we get on. Well, I didn't do very well, as you can see. This is a quick game, so let's just try it one more time, see if I can do better. It's a lot of fun, and you can see actually that it's almost futile to even try to time the market. So don't be too hard on yourself if you've just invested only to see the market tank. Just keep on investing and be patient. This is the case whether you're investing in individual shares, so long as you set stop loss limits and protect yourself from, really devastating losses. But particularly so if you're an index investor, i.e. investing in a tracker fund. Personally, in the past, my strategy has always been to invest in individual stocks when the market or index is retracted by, say, 5% from the latest peak. But often I feel myself sitting on the sidelines for months and months on end waiting for that retractment, during which time I'm missing out on at least one, if not more, sets of interim or final dividend payments. These can be substantial, so say take GlaxoSmithKline for example, paying at the moment just over 6% yield. They pay every quarter, so that's 1.5% of my money is paid every 3 months. Anyway, have a go at the market timing game and tell me how you get on. I think you'll find it a bit of fun. I hope you enjoyed this video, and if you have, then please hit that subscribe button and the like and notification bell. It really helps this channel out. But I'll catch you in the next video. I'm Anthony, and as always, we're talking money. But until then, bye for now.